Every few years, the market whispers the same story. This time is different. Every time prices drop, headlines scream of collapse, analysts argue, investors panic, and fear takes control. But let me tell you something that few ever grasp. The market doesn't crash, people do. Gold doesn't fall because it suddenly lost value. It falls because belief shifted, because the crowd that once saw safety now sees risk, because emotion, not data, dictates direction. The market is a mirror, nothing more, nothing less. When people look into it, they don't see gold. They see themselves. Their hopes, their greed, their fear of losing. The reflection changes not because the metal changed, but because they did. If 2026 brings a gold crash, it won't be the fault of central banks, inflation reports, or interest rates. It will be the result of a collective shift in emotion. A breaking of confidence, the invisible thread that connects belief to price will snap, and panic will fill the vacuum. But this is where true mastery begins, because every crash is also a clearing. Every panic wipes away illusion. Every collapse exposes who is truly prepared and who is merely pretending. The average investor sees red candles and thinks, it's over. The disciplined one sees the same chart and thinks, it's beginning. There's a profound truth in that difference. What separates destruction from opportunity isn't the market, it's mindset. The market doesn't decide who wins. Your perception does. When fear grips the masses, you must become the observer, not the participant. You must understand that emotion is the engine behind every crash, every rally, every sudden shift. You can't predict when it happens, but you can prepare for how you'll respond when it does. Because preparation is power, not prediction. Preparation. The trader who builds emotional discipline doesn't need to know whether gold will rise or fall in 2026. He already knows how he will act, how he will think, how he will stay calm while others unravel. He understands that the edge is never in the forecast, it's in the response. Think about that. Everyone wants to know, will gold crash? But few ask, what will I do if it does? That's where wealth is made. Not in the answer, but in the awareness. If a crash comes, it won't destroy you. Your reaction might, fear will tell you to run, to sell, to save yourself, but wisdom whispers, observe, don't react, because markets always overextend in both directions. What feels like destruction is often the soil of the next opportunity. This is how the professional thinks. He doesn't chase, he doesn't panic, and he never believes the crowd. He knows that mass emotion is temporary, but discipline compounds forever. Gold might crash in 2026, or it might not. It doesn't matter. What matters is whether you've trained your mind to stay neutral when the world loses its balance, because neutrality is the ultimate edge. It allows you to see clearly when others are blinded by emotion. A crash doesn't ruin disciplined traders, it reveals them. When the market breaks, most people break with it. But a few stay centered, calm, confident. They don't try to control the market. They control themselves. And in doing so, they turn uncertainty into advantage. So if you hear warnings about gold's collapse, don't get lost in the noise. Ask yourself one simple question. What does my reaction reveal about me? Because that answer, not gold's price, will determine your outcome. Remember this, markets don't warn you, they expose you. They reveal the truth of your beliefs, your fears, and your relationship with uncertainty. The crash, if it comes, isn't a tragedy, it's a test. And those who pass it aren't the ones who predicted it, they're the ones who prepared for it. So stop trying to forecast the storm. Learn instead to sail through it. Because in the end, mastery isn't about knowing where gold is going. It's about knowing where you stand when it moves. The first thing you have to understand about markets, whether it's gold, stocks, crypto, or any instrument of human speculation, is that they don't speak in words. They don't issue warnings. They don't whisper in your ear before they move. They simply reflect the collective mind of everyone involved. Every tick on a chart is a snapshot of human belief. Fear, greed, hope, denial, all playing out in real time. What we call price is just emotion quantified. When you look at a market, you're not looking at logic, you're looking at behavior. And behavior is driven by perception. Perception in turn is shaped by belief. That's why the same piece of news can make one trader buy and another sell. It's not the information that matters, it's the interpretation of that information through the lens of emotion. The market doesn't crash because gold lost its shine or value. It crashes because the collective psychology of participants shifts from confidence to fear. Every trader wants to believe they'll see it coming. They want the market to warn them, to give a signal before the storm hits. But that's the illusion that keeps most people trapped. There are no warnings in the market, only reflections. The chart doesn't tell you what's going to happen, it tells you what's happening inside people. And if you learn to see that, if you train yourself to read emotion instead of prediction, you'll stop being a victim of volatility and start being a student of behavior. Gold, for example, has always been wrapped in emotion. It's not just a metal, it's a symbol of safety, wealth, and fear of collapse. When people lose faith in currencies or governments, they run to gold. When they regain confidence, they run away. The metal itself doesn't change, human sentiment does. That's why every crash or rally is just a reflection of how the crowd feels about uncertainty. The market is not an oracle, it's a mirror. Let's talk about the psychology behind that. When traders feel in control, they believe they can predict outcomes. They overestimate their skill and underestimate risk. The market rewards that confidence for a while. It gives them wins, reinforces their belief, makes them feel certain. But certainty is the seed of every crash, because when enough people become certain, the crowd stops questioning itself. They start thinking the same way, reacting the same way, positioning the same way. And when everyone is positioned on one side of the boat, it only takes one unexpected wave to flip it. That's what crashes are. Massive psychological rebalancing. It's the collective mind waking up to its own excess. When fear erupts, it doesn't come gradually, it explodes, because the same emotional energy that built confidence now reverses polarity. The herd that was united in belief becomes united in panic. You see red candles, collapsing bids, news anchors yelling about destruction, but what you're really witnessing is belief collapsing under its own weight. If you truly want to understand markets, stop asking for warnings. The warning is already there. It's in the overconfidence of the crowd, the complacency of investors, the arrogance of certainty. The market doesn't have to say a word. It shows you everything if you're willing to look. But most people don't want to look. They want reassurance, not truth. They'd rather believe in a system that tells them when to buy or sell than accept that the real battle is inside their own mind. That's why understanding psychology isn't optional. It's essential. Because once you accept that the market is a reflection of collective belief, you stop fighting it. You stop arguing with price. You stop thinking, this doesn't make sense. You realize that it doesn't have to make sense. It only has to express emotion. When gold drops and panic spreads, the question isn't, why is this happening? It's, what belief is being destroyed right now? When gold rallies and everyone claims it's the next great hedge, the question isn't, how high can it go? It's, how long can confidence sustain itself before doubt returns? Every move up or down is a psychological pendulum. It swings between fear and greed, uncertainty and conviction. The market doesn't issue forecasts. It measures how far emotion has traveled from equilibrium, and when that emotion reaches its extreme, it reverses. That's the rhythm of every market that has ever existed. But traders don't want to hear that. They want signals, indicators, news catalysts, something outside themselves to blame when they lose because it's uncomfortable. To realize that what's really moving the market is what's moving inside you. When you feel fear, you're not alone. Thousands of others are feeling it too. When you feel greed, the same vibration echoes across the trading world. You are part of the reflection you're trying to interpret. That's why objectivity is so hard to achieve, because you're not watching the market, you're watching yourself through it. This is why mastering mindset is more powerful than mastering any indicator. You can't control gold, but you can control your reaction to gold's movement. You can't stop a crash, but you can stop yourself from being emotionally dragged into it. And that control, emotional control, is the ultimate edge. Most traders lose not because they lack information, but because they lack emotional stability. They react to the market as if it were attacking them. But the market isn't personal. It doesn't know your position, your pain, or your plan. It's not out to hurt you. It's just reflecting the cumulative emotional state of everyone participating, including you. When you realize that, you stop taking moves personally. You stop fighting the mirror and start studying the reflection. Let's go deeper into this. When you see a sudden drop in gold, you might think, the market is warning us. But what's really happening is that collective psychology has hit a breaking point. The crowd that once felt safe now feels threatened. They're dumping positions, chasing liquidity, reacting to each other's fear. The warning wasn't in the drop, it was in the complacency before it. The calm before the storm was the warning. The illusion of safety was the setup. Think about how humans process uncertainty. We hate it. We'll do almost anything to replace it with the illusion of control. That's why people buy at highs. They want to feel part of certainty. and why they sell at lows. They want to escape uncertainty. The irony is that both decisions are driven by the same emotion. Fear of missing out, fear of loss, two sides of the same coin. The market reflects both perfectly. It doesn't judge, it just displays. So when people say gold is crashing, beware. The real message isn't about the metal, it's about emotion. It's about the transition from confidence to fear. And the professionals, the emotionally disciplined traders, don't see this as a warning. They see it as information. They understand that market behavior is nothing more than mass psychology in motion. This is where awareness becomes power. If you can detach from the emotional current that moves the crowd, you begin to see the structure underneath the chaos. You start to recognize patterns of behavior instead of chasing patterns on a chart. You learn that price isn't random. It's reactive. It reacts to belief, and belief is observable if you know where to look. Volume spikes, panic selling, euphoric headlines, social media sentiment, all signals of the collective mind. But again, these aren't warnings. They're reflections. The market doesn't care if you're ready. It only shows you the truth of where belief stands right now. You can either accept that truth or resist it. The moment you resist, you lose clarity. You start trading what you want to see instead of what's actually happening. This is why mastery in trading isn't about prediction. It's about perception. The professional doesn't ask, what will the market do? He asks, what is the market showing me about the collective mindset right now? That question changes everything because it shifts your focus from future outcomes to present awareness. If gold crashes in 2026, it won't be a mystery. It'll be the visible result of invisible emotion, a reflection of belief unraveling. Those who understand psychology will recognize it not as a catastrophe, but as a natural expression of imbalance correcting itself. The crash won't warn them. It will confirm what they already felt beneath the surface. You can't avoid reflection. You can only interpret it more skillfully. You can't control the market's behavior, but you can master your own, and that mastery allows you to see opportunity where others see danger, because when everyone else is reacting to emotion, you'll be responding to awareness. The next time the market moves sharply, ask yourself this: what emotion is this move reflecting? If you can answer that honestly, you'll see the chart differently. It won't be random candles or patterns. It'll be human energy in motion. Remember this truth: the market doesn't send warnings. It mirrors the mind of the masses. It reflects your own inner state. Every crash, every rally, every sideways grind is a portrait of human belief, painted in price. When you stop asking for signs and start studying reflection, you'll stop fearing the market and start understanding it. Because in the end, the market is not a monster to be tamed, it's a mirror to be read. And the one who learns to read it learns to master himself. The world loves to blame fundamentals for every crash. Economists point to interest rates, inflation, policy shifts, or weak GDP. Analysts talk about overvaluation, debt, or supply and demand. But if fundamentals truly created crashes, markets would fall with precision and logic. They don't. They fall with emotion, with panic, with hysteria, with the sudden contagious realization that confidence has vanished. Fundamentals explain what might justify a move. Fear decides when that move happens and how far it goes. Look at any major collapse in history. Gold, stocks, housing, crypto. It's never just about numbers. It's about emotion breaking free from structure. It's about belief snapping under pressure. It's about fear taking the wheel and logic sitting helplessly in the back seat. Markets don't move because reality changes. They move because perception of reality changes. And nothing distorts perception faster than fear. Fear is the great amplifier. It magnifies risk, erases patience, and blinds traders to probability. When fear enters the system, small events become massive. Minor corrections look like disasters, and rational thinking disappears. The same trader who held confidently during a rally suddenly can't hold through a small retracement. The same investor who spoke of long-term conviction now panics over a two-day drop. Why? Because fear hijacks the emotional system. It shuts down logic and turns the market into survival mode. When fear spreads, fundamentals become irrelevant. It doesn't matter what the intrinsic value of gold is. It doesn't matter if central banks are buying or selling. It doesn't matter what the charts say about support or resistance. When collective emotion flips from confidence to panic, the selling becomes reflexive. People don't sell because it's smart. They sell because it feels safer than doing nothing. And in that moment, price becomes a thermometer of emotion, not of value. That's what most people never grasp. Fear doesn't follow data. It anticipates pain. The mind doesn't wait for confirmation to panic. It imagines the worst and reacts as if it's already true. A rumor can cause more damage than a report. A headline can erase years of belief in seconds. That's because the crowd doesn't respond to truth. It responds to threat. And markets, at their core, are threat detection systems. When traders see red candles, they don't see opportunity, they see danger. And when enough people feel that danger simultaneously, they create a feedback loop. One sells, another reacts, another panics, and before long, a cascade begins, not because fundamentals changed, but because perception collapsed. Fear creates momentum in the wrong direction. It accelerates losses and magnifies volatility. And once the herd starts running, it doesn't stop to question why. It just runs. It doesn't matter if the panic is justified. In fact, most of the time, it's not. Markets have crashed over misunderstandings, rumors, algorithmic glitches, even false headlines. The cause is rarely the problem. It's the reaction that defines the crash. Here's what makes fear so destructive. It hides itself as logic. People will say, "I'm just being cautious," or "I'm protecting my capital." But underneath that rational surface is pure emotion. The same mind that was euphoric at the highs now demands safety at the lows. It pretends it's making rational decisions, but what it's really doing is seeking emotional relief. Fear doesn't want profit, it wants comfort. And the market punishes that desire ruthlessly. Think about gold. Historically, people buy gold out of fear. Fear of inflation, fear of currency collapse, fear of financial chaos. But when that fear becomes excessive, it flips. The same crowd that bought gold as a refuge starts selling it because they're afraid itself is about to collapse. Fear consumes itself. The safe haven becomes the danger. The logic disappears. And what's left is emotional contagion, panic feeding on panic. That's why every crash looks irrational while it's happening, because it's not about logic, it's about emotion in motion. Markets don't fall because investors analyze data and calmly decide to sell. They fall because fear takes over and rational thinking shuts down. That's why you'll never find a formula that predicts a crash. You can't quantify panic, you can only recognize it when it starts to appear and decide how you'll respond. Fear is contagious because it offers belonging. When you're afraid and you see everyone else reacting the same way, it feels safe to join them. No one wants to stand alone while the world collapses. So the crowd moves together, not toward truth, but toward emotional safety. And ironically, that safety is the source of destruction. Because when everyone sells at once, liquidity disappears and price collapses further, confirming the very fear that caused it. This is how fear feeds itself. It seeks validation. Every red candle becomes proof that you were right to panic. Every drop confirms the narrative of doom. And when that narrative takes hold, it spreads like wildfire. Social media amplifies it. News headlines fuel it. Traders repeat it. It becomes self-fulfilling. And by the time it's over, fundamentals finally catch up. Not because they changed, but because the market's emotion forced them to. But fear isn't the enemy, it's information. It's the purest signal of where the crowd's belief system stands. When fear peaks, it means the collective mind has reached emotional exhaustion. That's why some of the biggest opportunities in history were born from panic, because when fear saturates the market, the selling pressure is already spent. There's no one left to sell. And at that exact point of despair, the seed of recovery begins to grow. Most traders, however, never see that moment. They're too busy protecting themselves from imaginary future losses to notice that the worst has already passed. They confuse discomfort with danger. They think that because something feels bad, it is bad. But that's the illusion fear creates. It turns emotional pain into perceived reality. Here's the truth. Markets don't punish courage, they punish ignorance. Fear isn't supposed to be eliminated, it's supposed to be understood. The professional trader doesn't fight fear, he studies it. He learns to recognize when it's rational and when it's not. He understands that fear always tells a story. And that story usually says more about the crowd than the market itself. When gold starts dropping and fear spreads, the disciplined trader doesn't panic. He watches, he listens to the emotional tone of the market. He sees headlines screaming about collapse, but he interprets them as evidence of capitulation, not confirmation of doom. He knows that when fear dominates the narrative, opportunity hides in the background. Because the truth is, the market never punishes emotion, it punishes reaction. Feeling fear is natural, acting on it impulsively is destructive. The difference between a professional and an amateur isn't that one feels no fear. It's that one understands it while the other obeys it. Fear is simply energy without direction. When you let it control you, it turns to chaos. When you channel it, it becomes clarity. It sharpens your awareness, reminds you of risk, and keeps your ego in check. But you must master it, not submit to it. Because the moment fear makes your decisions, you stop trading the market. You start trading your emotions. The market doesn't crash because fundamentals break. It crashes because belief does, and belief breaks when fear becomes louder than awareness. Every chart, every headline, every panic-driven move is just another expression of the same truth. Humans hate uncertainty more than loss. That's why we'd rather take a small certain loss than risk facing an uncertain future. But trading is nothing but managing uncertainty. The moment you try to escape it, you destroy your edge. If a crash comes, and gold plunges in 2026, it won't be the fault of the Fed or inflation or global economics. It will be the result of mass fear overwhelming logic. It will be the crowd's collective attempt to escape uncertainty, and those who understand that will not only survive it, they'll thrive through it. Because while fear drives most people to sell, it drives a few to observe, to stay calm, to wait for the emotion to burn itself out. They know that markets always return to equilibrium, that emotion always exhausts itself, that panic always precedes clarity. They know that fear, though powerful, is temporary. If you can learn to stay centered when others are losing control, the market will reward you, not immediately, but inevitably, because emotional stability is rarer than any strategy and more valuable than any forecast. The next time you feel fear rising, don't fight it. Ask yourself what it's telling you. Is it alerting you to genuine risk, or is it your ego resisting uncertainty? If you can answer that honestly, you'll see that most of what you call fear isn't danger. It's just discomfort, and discomfort is where growth happens. Fear creates crashes, yes, but only for those who mistake emotion for truth. For those who can see through it, fear is opportunity wearing a disguise. The market doesn't care about fundamentals as much as it cares about feelings. Fundamentals describe, fear decides. Fundamentals measure, fear moves. And once you truly grasp that, you'll stop searching for reasons and start focusing on reactions. Because in every crash, one thing never changes. The metal, the stock, the asset, it's still the same. What changed was belief. What collapsed wasn't value. It was confidence. And when you can stand calmly in the center of that storm, understanding that fear is the cause, not the condition, you become untouchable. The market may crash, but your clarity won't, because the professional knows fear doesn't destroy markets. It reveals who's mastered them. There is a moment in every market cycle when panic becomes so loud that it drowns out reason. You can feel it. You can see it in the charts, in the headlines, and the desperate chatter of traders who once sounded confident but now sound broken. That moment, the one where it feels like everything is falling apart, is the same moment that separates those who survive from those who thrive. It's the moment when mastery begins to speak quietly beneath the noise. The amateur sees red candles and destruction. The master sees potential energy. The amateur reacts to emotion. The master observes emotion. What makes the difference is not information, not even experience. It's perception. The ability to see opportunity where others see doom comes from mastering your perception of risk and your relationship with uncertainty. Every collapse has two sides, the external market side and the internal psychological side. Most people only see the first. They watch the charts, the breaking news, the price falling, and they panic. They assume the market is signaling disaster, but the master understands that the market is not a predictor. It's a mirror reflecting collective emotion. When everyone sees doom, it's not reality. It's a reflection of mass belief. And when that belief hits its emotional extreme, it becomes unsustainable. What follows panic is always opportunity. Think back to every major crash in 2008, in 2020, in every financial panic before and after. What looked like the end was, in truth, the beginning, for those who had the courage to see it differently. The majority sold in fear, the few bought in faith. The same pattern has repeated across centuries because human emotion never evolves as quickly as technology or data. Markets change, but people don't. To see opportunity where others see doom, you must train your mind to separate what feels real from what is real. Doom feels real because emotion makes it feel urgent. When fear surges through your system, it demands immediate action. Your mind screams, do something, anything. But mastery comes from resisting that impulse, from stepping back and observing the storm without letting it pull you in. The market rewards those who can stand still in the chaos, not frozen in fear, but grounded in awareness. While others are driven by emotion, the master becomes a witness to emotion. He understands that crashes are emotional events first, financial events second. He recognizes that every panic has a tipping point, and that once it passes, the very energy that caused destruction becomes the fuel for the next rise. The reason most people never see opportunity in crisis is because they define opportunity by comfort. They want opportunity to feel safe. But the truth is, the best opportunities never feel safe. They feel terrifying. They appear wrapped in uncertainty, dressed in fear, disguised as danger. That's why so few ever seize them. Mastery is not about courage in the traditional sense. It's about emotional neutrality, the ability to look at fear without identifying with it, to see panic in the market and not let that panic enter you, to recognize that every extreme emotion in the crowd signals exhaustion, not continuation. When the crowd feels absolute certainty, whether bullish or bearish, it's usually wrong. The market moves in cycles of emotional imbalance, and the professional waits patiently for those extremes to appear. Seeing opportunity in doom means learning to interpret emotion as data. When everyone is euphoric, it's a sign of overconfidence. When everyone is terrified, it's a sign of capitulation. The master doesn't argue with emotion, he reads it. He studies it the way a meteorologist studies weather, without judgment, without attachment. He doesn't say, "This is bad." He says, "This is what's happening." That distinction seems small, but it's everything. Because once you stop labeling market events as good or bad, you start to see them simply as movement. And movement, no matter the direction, always creates opportunity. Doom is not the enemy of the trader, it's the raw material of fortune. Every crash clears the field. It shakes out the weak hands, resets valuations, and creates the conditions for a new phase of accumulation. The few who understand this quietly position themselves while the crowd runs away. This mindset doesn't come naturally. It's built through pain, through mistakes, through learning that survival in trading isn't about being right. It's about staying emotionally stable when everything else falls apart. Mastery isn't born from avoiding fear. It's born from facing it repeatedly until it loses its power. Each time you resist the urge to react to panic, you strengthen the muscle of discipline. Each time you act from awareness instead of emotion, you move closer to mastery. There's a paradox here. The moment of greatest fear is often the moment of greatest opportunity. But you can only see it if your mind isn't consumed by fear. When gold, stocks, or any asset is crashing, most traders can't imagine recovery because they're emotionally identified with the fall. They feel the collapse, so they believe in collapse. The master doesn't deny what he feels, but he doesn't become it either. He observes it, separates it, and looks at the bigger picture. Opportunity isn't hidden. It's just invisible to those blinded by emotion when everyone is convinced. The world is ending. The professional knows it's beginning again in a new form. He understands that markets are cycles of emotion, and that panic is simply one stage in that cycle. He sees value where others see chaos, not because he's smarter, but because he's calmer. His edge is emotional, not analytical. The key lies in belief. Your beliefs about the market shape what you're capable of seeing. If you believe that crashes are dangerous, you'll avoid them and miss the recovery. If you believe that fear equals opportunity, you'll prepare to act while others hesitate. The market doesn't reward analysis. It rewards belief systems that align with its true nature. The market's nature is uncertainty, and the trader who embraces that truth finds freedom in it. The amateur seeks comfort. The master seeks clarity. Comfort clouds judgment. Clarity reveals truth. To see opportunity in doom, you must learn to feel discomfort without letting it dictate your behavior, because discomfort is where awareness lives. Growth never happens in ease. It happens in resistance. When the world looks hopeless, your calmness becomes your advantage. You can't control the market, but you can control your focus. During panic, most people focus on loss, on what they could have done differently, on what might go wrong next. The master focuses on what is, on the current structure, the current emotion, the current imbalance. He's not looking backward or forward, he's anchored in the present moment. That's where clarity lives, and clarity breeds opportunity. Seeing opportunity in doom also means trusting probability over prediction. The market doesn't promise certainty. It offers potential. The master doesn't need to know when the crash will end. He just needs to recognize the signs of emotional exhaustion when they appear. He doesn't try to catch the exact bottom. He positions himself when risk and reward become asymmetric. While others wait for proof, he acts on probability. What separates mastery from mediocrity is not knowledge. It's mindset. The professional has trained his mind to interpret chaos as part of the process. He doesn't pray for calm markets. He thrives in volatility because volatility is opportunity. He doesn't fear the storm. He studies its rhythm. He understands that the same force that destroys the unprepared builds the disciplined. When others see doom, the master sees energy transferring hands. He sees the weak giving up control, selling their assets for emotional relief. He sees value being transferred to those who can withstand temporary pain. Every crash is a transfer of wealth from the emotionally reactive to the emotionally prepared, and preparation in trading doesn't mean prediction. It means alignment. Alignment with uncertainty, alignment with discipline, alignment with reality as it is, not as you wish it to be. The ability to see opportunity where others see doom is not about optimism. It's about realism. It's understanding that markets, like nature, operate in cycles. Winter always feels endless, but spring always comes. The doom you see today is the soil from which tomorrow's growth will rise. The master doesn't deny the cold, he prepares the ground. When you watch panic unfold, remind yourself that the market doesn't destroy. It transforms. What looks like chaos is reorganization. What feels like the end is often a reset. The crash that wipes out the impatient creates space for the patient, the fear that drives most. To quit becomes fuel for those who endure. Mastery is simply the art of emotional alignment. The ability to remain balanced. While the world around you swings from euphoria to despair, it's knowing that your perception of the market will always mirror your internal state. If you cultivate calm, you'll find clarity. If you feed fear, you'll find chaos. So when the next crash comes, don't ask, why is this happening? Ask instead, what opportunity is this emotion hiding from me? That single shift in mindset separates those who lose everything from those who build their legacy in the ashes of panic. The truth is simple. Markets don't reward bravery, they reward awareness, and awareness is what allows you to see light in the darkest moments, order in chaos, and opportunity in doom. Because when others see destruction, the master sees rebirth. When others see risk, he sees probability. When others see panic, he sees clarity. That's not luck, it's discipline. It's the result of thousands of hours spent training the mind to interpret fear not as danger, but as signal. And when you reach that level of mastery, when you can look at a market collapsing and remain calm, composed, focused, you'll realize something profound. Opportunity never disappears. It only changes form. While others run from the fire, you'll walk through it with awareness. You'll understand that the flames don't destroy, they refine. That's what mastery truly is. Not escaping the storm, but learning to see through it. Because in the end, the difference between those who fall and those who rise isn't in what they see, it's in how they see. The market gives both the same picture, doom for one, opportunity for another. In the end, markets don't destroy wealth, they expose mindset. Every crash, every panic, every wave of fear is simply a test of belief. The ones who fall are those who see danger and run. The ones who rise are those who see beyond emotion and act from clarity. Mastery isn't about predicting what happens next. It's about staying centered no matter what happens. When you can see opportunity where others see doom, fear loses its grip on you, and the market becomes not an enemy, but a mirror of your growth. That's where real freedom and real wealth begin.